Don't be fooled by the rally we've seen in the stock markets over the last month. This is not the beginning of a new bull market. In fact, be prepared for another ugly downturn. This is according to our next guest, Clem Chambers, who is the CEO of Online Blockchain. We'll be talking about the markets, the Federal Reserve, and how the Federal Reserve's balance sheet links with the markets, Federal Reserve policy, cryptos, inflation and commodities, and everything to do with the economy. Welcome back to the show, Clem.
Thanks to be back. Good. Thank you, David.
Clem, last time you were on the show, which was about a month and a half ago, 2 months ago, actually, you were talking about another major correction that would happen. Now, the markets have seen corrections over the course of the last month and a half, but generally speaking, Clem, the direction of the S&P 500 and the NASDAQ and the major stock indices in the U.S. have the direction has been up over the last 2 months or so. It's bottomed around October, and it's up to about 4,000 points. Just a few days ago, I'm talking about the S&P 500, and it's recently come back down in the last week or so. Now, Clem, some people have said that this possibly is the bottom for the stock markets because if you're looking ahead at the Federal Reserve, they are slightly less hawkish than before, and so perhaps now is the time to be buying back in. How would you respond to that?
Well, I think now is exactly the wrong time to be buying back in. You could, if you wanted to, say, well, it's going to come down, it's going to get another bottom, it's going to rally again, and then you want to buy at the bottom of each correction and sell at the top of each rally. And all you have to decide is this a bear market or is it a bull market? Well, it's not a bull market, not in my book, so it's a bear market. And a bear market always goes up like a rocket and comes floating on down, 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 down. And the lows are lower and the highs are lower. But when it does rally, it goes up sharply. See, there's a difference between a bull market and a bear market, and that's the shape of the market. In a bull market, it floats up and it crashes down. It floats up and it crashes down. In a bear market, it spikes up and it floats down. And that's what you're seeing now. Spike up, float down. But the overall direction is down. And the bottom, well, where's that going to be? That's probably quite a lot lower than we're seeing today. Because what's driving it is money being pulled out of the whole system by the Fed as they're selling down their balance sheet and drawing liquidity, i.e. cash, out of the market. And you're going to be seeing that for quite a long time. And that's just going to take the wind out of the sails of all these assets that have been pumped up by money supply.
Okay, let's define bear market and bull market. What are the percentage moves in a certain period of time that qualify the markets to be categorized in either camp?
You're pressing one of my hot buttons here. Look, back in the day, in the good old days, the difference between a bull market and a bear market was direction. So you could be right at the top, and then it could go down for a couple of days. And if you're smart enough, you'd realize, wow, now we're in a bear market because this is going to keep going down for a long time. I'm in a bear market. And people say, what are you talking about? It's been going up for 5 years. It's only gone down for 2 days. This is a bull market. It's going to go up and up and up and up and up. But actually, it's about the tendency. A bull market tends to go up and is heading up over the medium and long term. A bear market is heading down over the medium and long term. And in a bull market, everyone's a genius. In a bear market, everybody's an idiot and everybody loses money pretty much. And therefore, you need to know what market you're in. No point in being long in a bear market, is there? Right. But if you actually then focus in on the difference between a bull and a bear market, a bull market will tend to float up and then go crunch and then float up. And every time it floats up a little bit more than before it fell. Right. And in the bear market, it floats down, down, down. It goes bang, floats down, 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 bang. It's the opposite shape. Yeah. And that's how you can tell which market you're in. And this is a bear.
Are you still in cash, 100% cash? You were 2 months ago.
Well, 90-something cash. Yes, big mountains of cash getting eaten away by the moths of inflation. Unpleasant.
Okay. So you rather lose 7% in inflation than perhaps more in the stock markets. Is that your thinking?
I'd prefer to have my money in Benjamins than in Facebooks.
Okay. Wow. That makes sense. Okay. What about I'm gonna ask you about the non-Facebook stocks, the other stocks that you think have more potential than the things that don't aren't necessarily going to do well. Let's revert back to the Fed. Last time you were on the show 2 months ago, the Fed was relatively hawkish. You had said that they have announced pain, and they have. Their tune has somewhat changed since. A couple weeks ago, you recall that Jerome Powell has said in a speech at the Brookings Institution in Washington, D.C., that he may slow down the pace of rate hikes going forward. And now it's telegraphed that 50 basis points is all he's got left in December. Well, we are in December. I'm talking about the meeting next week. So what's next?
So they're going to just whip us less. Now, it's all about liquidity, okay, which is a new word for money, for cash. And, you can pump money into the economy in a way that it doesn't create lots of liquidity. And that's what the old-fashioned QE used to do. But they pump so much in, they've got to pull it out. And it means that the value of assets as denominated in money is going to go down. I mean, if you are going to, the only question is, are they really going to control inflation? Or are they going to just control it a bit? Are they going to bring it down to 4 or 5%? Or are they really going to bring it down to 2%? Because there's a big difference there. Because there's a big difference on the amount of money they have to pull out of the market. But if you believe what Powell's saying, they're going to do that. And if they're going to do that, it's a long, hard road. And, why would equities go up in a long, hard road? Some people would say, well, look, it's inflation. So, a Microsoft share is going to be worth in numbers 11% more if you've got 11% inflation. If you've got to have 6% inflation, it's going to be worth 6% more. It's the same amount of buying power, but the numbers go up because they're going up with inflation. Well, that didn't work in the 70s, the last time we had, runaway inflation or high inflation. The equity market really suffered because everybody went, oh, no, this is not a right environment. This is a scary environment. And that fear knocked equity prices down a long, 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 long way over that long period of inflation. So that is what we're risking, and that is yet another bear market, direction. I mean, where is the bull market direction? What exactly is going right that equities should be worth more? I mean, nothing's going right. Even Warren Buffett's losing money. I mean, Warren Buffett is losing money. I mean, come on, how bad can it be?
Yeah, it seems to me the only people who are not losing money these days is the government. Although one could argue they've been losing money for a while and they will continue to do so.
They're losing a huge amount of money. It's called their deficit. All right, it's only $1 trillion now. Yeah, the American sustainability.
I was making a reference to the fact that the economy is getting bigger overall, but you're absolutely right. And of course, with higher interest rates, they have to pay more in interest expenses. But you did point something out very interesting to me, which is the level of the Fed assets, the balance sheet of the Federal Reserve, has been more or less correlated with the stock markets. You'll see that it's the level of the Federal Reserve's balance sheet has peaked somewhat earlier this year, at around June, May, and has been teetering ever since because of quantitative tightening, no less. And of course, the stock markets have been going down all year. Has had a slight rebound in the summer, but again, following the curve of the assets that we've seen, has been going down. Explain this for us.
David, they turned the tap off in December last year. That's when they turned the tap off. That was the high. And ever since then, after the tap was turned off, and now they've been sucking money out. It's been down, 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 down. Now, what then happened was the dollar went through the roof because of interest rates, and that threatened to crush the whole global economy because the dollar was running away. So, and also, it doesn't do America any good to have an incredibly strong currency and they can't export. So they reined that in, and up goes the market because that's the equivalent of a sort of offset of an interest rate cut in a way. Because if they'd let the dollar carry on running, it would have been absolutely mayhem all around the world. One of the reasons why the British pension fund industry nearly collapsed was the strong dollar, right? So they reined in the strong dollar, and up goes equities. Well, that process is over now, and you're going to see it trend back down to previous lows. I think that's highly likely until someone says to me, "Oh, don't you realise this is X, Y, and Z has gone right? This is good news coming down the pike. Oh, it's wonderful. Growth. Yes, excellent stuff is coming." Well, why would equities go up? Money supply, which drove asset prices, is in reverse. So it's going to drive asset prices in reverse.
How much further can this reversal go? If we're talking about a reversal, well, we've got some room to go, haven't we?
You know, it's much easier to predict the past. And if I am looking at the future, there's two outcomes. One is you're going to have this big sideways trading volatile range thing going on. And you can see that in the Dow after 2000, when basically the Fed was doing what they're trying to do now, which is pin it in a band and let the economy catch up, and let economic activity catch up with the situation that was left by the dot-com crash. And, that's a very tricky game. And obviously 9/11 came along and spoiled all that. But nonetheless, you've got this long-term range, which was allowing the economy to catch up with asset prices. And they will try to do that again. But if they fail, for whatever reason, it's a long way to go, long way to drop. And so there's this tension between the overarching management of the economy these days. It's not a free economy. It's a highly managed economy. Will the Fed be able to keep the wheels on? And if so, you're going to see a sideways channel.
Right.
But if it breaks that, like it almost did a few weeks ago, then there's a long way down. And if it breaks that, what you'll get is what we had in 2000, 2007 and 2008. Because everyone remembers the big drop in 2008, but there was a bear market in 2007, which was the oncoming storm. And I think what we're in now is potentially an oncoming storm. And if you look at 2007, 2008, 2009, you can see a pattern that if things go wrong, will repeat. And if it doesn't go wrong, we'll get this sideways trading thing where if you're brave enough, you buy at the bottom of the channel and you sell at the top, which is a very tricky game to play.
In 2008, one of the impetuses for the crash was the collapse of the housing market in the United States, which caused a ripple effect throughout the entire financial system. What is the impetus of this oncoming storm, Clem?
Well, the impetus for that was rising interest rates. Back in 2006 and 2007, the real estate market was running hot. And so they jacked up interest rates to cool that down. They didn't realize that behind some door somewhere that they never looked, there was all these dodgy derivatives going on. There's all this dodgy, wholesaling and retailing debt into the housing market. And you can see the oncoming storm with the way that there was a bear market, because the credit market started to freeze up because there was a tightening, and then credit started to freeze up, and then all those dodgy derivatives went south, and then you got the global financial crisis. But it was interest rates going up that triggered that originally. And you could blame it on the regulators for putting interest rates up too high. If they hadn't done it so dramatically, maybe all those dodgy derivatives would have washed out over a few years, but they didn't. Up went interest rates, something broke. And up went interest rates in the UK, and the British pension system broke. And out came the government and threw $100 billion to keep the whole thing together into one piece. Right?
It seems to me,
interest rates up, something breaks. That's what will potentially happen.
You're absolutely right, Clem. It seems to me that higher interest rates seems to be this big bad word in the financial press these days. But when you think about it, interest rates go up and down with cycles. It's not necessarily the end of the world if interest rates go up. It all depends on the context, right? Why is it particularly bad this time around that interest rates are going up?
Well, because, I can go down to my private bank and I can say, lend me 100 million.
Okay.
And they'll probably go, yes. And then I'll go out and buy a load of assets. I go buy a load of Picassos. And, all this money's coming to the system. The Picassos bubble. So I go in up to Sotheby's and they sell them for me. I've just made 100 million. That's great. I can keep doing that until suddenly interest rates go up and people aren't buying Picassos anymore. And I've got a load of Picassos and I've got a 500 million debt and I can't service that money and I go bust. That's it. That's what leverage does. Low interest rates enable huge leverage. And we've seen that in crypto. Huge leverage has blown up, a fairly large proportion of that whole industry, because low interest rates, bring on leverage, because that's the whole point of low interest rates, is to get people to borrow money and spend it to make the economy go faster. But the dark side of that is the sort of people that go all in on cheap money. Remember when Mr. Trump said, I'm a kind of low interest rate guy. Yeah, well, he's gone bust a few times that way. You borrow a load of money, the economy goes sour on you, interest rates go up, you can't pay off your debts, you can't service your debt, you go bust. So that's the trouble with raising interest. All those people, which Mr. Buffett would say are swimming naked, well, that tide is a tide of money, and when it goes out, well, they're exposed as naked, but they go bust. And that's what causes the sort of cascade that people like the Fed want to avoid, because once the weak go to the wall, then the not so weak go to the wall, and then the not weak at all go to the wall, and then the quite strong go to the wall, and then the strong go to the wall, and then everybody goes to the wall. And that's what financial contagion is all about. And the thing that sparks that often is cheap money followed by not cheap money.
Well, okay, Clem, lots to unpack there. You know, I was wondering whether or not the Federal Reserve is actually going to stop raising interest rates sometime soon, because exactly like we discussed offline, inflation seems to have peaked, at least on paper. You'll recall that the CPI has peaked in June in the U.S. at 9.1%. It's come down to the sevens now. That's a pretty dramatic drop over the last 2 months or so, 3 months, a couple months. Now, nowhere near the Fed's 2% target, of course, but we're on the trend downward, right, Clem? Or no?
Well, let me tell you, the professionals in the big investment banks will tell you, oh, inflation's going to come down, the economy is going to go into a tailspin, they're going to go on another printathon. That is the institutional professionals' point of view of what happens next. They say inflation's going to really fall really fast, and the economy is going to do a nosedive, and out going to come the Fed and print money like no tomorrow again, and off will go the markets and la-di-da. Now, they can do that, but you won't get rid of inflation if they do that, because inflation is being driven by money supply. Yeah. Now, obviously, various things went through the roof because of all the money supply, but unless you pull it in, yeah, if you keep printing more money because you've got a fiscal deficit of a giant size, you've got to feed that deficit. You've got to print basically the amount of money to fill the deficit. So if you're printing an extra trillion every year to fill up your government deficit, you're going to get underlying medium scale inflation, 4, 5, 6%. Well, you know, if they're going to be happy with that, then there'll be 4 or 5 or 6% inflation. It won't be great for equities, but it won't be desperately bad. But if they really do want to drive out inflation, something's going to break. Something's got to break. Yeah. And governments can't keep printing these the money to fill up these huge deficits. They've got to get the deficits under control. Now, you can actually get away with this because you can have 3, 4, 5% inflation for 4 or 5 years. And that's what I was predicting would happen all along. But when your politically independent central banker comes out and says, we're not doing that, we're not having any of that, we're going to get it back down to 2%, you've either got to take him at his word or say, no, he's just lying. And if he's lying, well, it won't be so bad. And if he's telling the truth, boy, we're going to have a bumpy road ahead in the next couple of years. So that's the call we've got to make. Is it just another one of these, you know, semi-political guys jawing it, or do they really mean it? If they really mean it, there will be an almighty crash. If they don't really mean it, there won't be.
This is why I love interviewing, Clem. Amongst, of course, your wise analysis and very thorough discussion, you're giving me headlines, ping, ping, left and right. I love it. But Clem,
Let's help.
Let me come back to this almighty crash that you're talking about. Towards the end of this interview, I do want to get your final outlook. But, you know, it's almost Christmas time, Clem. Give us some good news. If I were to ask you to come up with a hypothesis, just suppose that the markets are going to have a huge relief rally by the end of the year. Just suppose it were to happen. Help us reverse engineer that result. What would need to happen for the markets to spike up back to 4,500 points by, I don't know, Q1 next year?
David, I'll give you some great news. Okay. There is nothing better than a crash to buy. When you've got a crash, that's the time to buy. You can go out and you can mortgage your.
The problem is you don't know when the crash is going to be over, right?
Well, you know when the crash is over. All you've got to do is count to 10 after it's happened. All you've got to do is count to 10 when the headline in the Wall Street Journal is the end of capitalism as we know it. All you've got to do, you've got tons of time. You can just sit there for 3 or 4 months. You can even let it start to recover 6 months later. You've got all the time in the world. And when it's over, you can fill your boots and be happy to know that you've got in at the bottom. Get in at the bottom, get out of the top. Get in at the bottom, get into the mid, get out of the middle. The key thing is to get in at the bottom, and that's really easy because that's when everybody says it's all over, it's the end of the world. Oh no, it's everyone else's fault. I lost all my money. Oh, it's all a big con. I hate it. I hate it. I hate it. Then you know it's the time to buy. When they cry and it's on the 10 o'clock news that it's the end of the stock market as we know it, that's the bottom. It always is.
Are people crying? Who's doing this crying right now? Anybody in your life? Anybody you've observed?
That's why I'm not bullish. No, nowhere near enough.
Well, hold on. Like a lot of people lost money with the. I'm not even talking about just FTX, but cryptos overall this year. Given, of course, cryptos is not a huge market in terms of market cap. Comparing market cap sizes, cryptos and stocks, even the bond market's incomparable in size still. But a lot of people lost money. A lot of people got sued.
Close. It's close in crypto. It's close. It's not here yet. There's one more.
It's like $3 trillion. $3 trillion was the peak, but we're nowhere near that. We're deflated. Anyways, let's talk about FTX. You said you'd rather have money in Benjamins than Facebook. Okay. Why not Facebook? Why not cryptos?
Well, not yet. Not yet for crypto. It's like, the thing about don't try to capture.
I don't mean to lump cryptos with Facebook and tech.
No, but we're in this gigantic bear market, right?
Right.
All you've got to do is go back to the day before Mr. Trump got elected and look at the markets. They just go like that.
Yeah.
They just go up vertically.
Yeah. Markets did like Trump.
If you go back to .com and you look at that market, you go, well, it was obviously a bubble. No, so look at it. It just went like that. Oh, it's obviously a bubble. Oh, look, it went over and it crashed. That was obvious. Well, just do the same. Use the same mindset on the current set 2 or 3 years, and you'll see these verticals, right? Well, they go up like a rocket and they come down like a rock at some point. There's COVID, right? COVID, down goes the market. Wham! What went right to do that? Well, we know what went right. They printed so much money, it all went into assets. And then they made a big classic mistake. Is they then threw money out the helicopter to everybody, to all the people that need to spend money and want to spend money. And then bang, it went into the economy and bang, up went prices. It's the oldest story ever. Yeah. And it's followed by them trying to rein that in. And there's a problem. The governments are still spending money like a drunken sailor. So they're still going to have to print more money. So you've got this oncoming collision. And we're in the middle of it right now. We're maybe even at the beginning of it right now. And if you want to have an idea of what could happen if, there's not a lot of very clever work done to stop a really bad set of economic outcomes coming up soon, just look at 2006, 7, 8, 9, because that chart will be, ringing going forward.
Give us some kinds of stocks, maybe not specific names, but sectors of stocks that you think may survive this next almighty crash.
Oh, they'll survive. They'll survive just fine, but there'll be much lower numbers, and then you can buy them and then go through the roof. That's my point. Rather than try to surf this downhill slope, just let it base. Save your cash, let it base, and then pile in at the bottom.
Well, what for our viewers who perhaps
are falling knife?
That is true, because you never know when it's going to keep falling further. But for our viewers out there who are perhaps fund managers who have a mandate to stay invested in some sort of market, they can't just be 90-something% cash. They have to be somewhere. Where should they be, Clem?
If they can't be in cash, well, they've got a major problem. It's investing right now is a major problem. Unless you're a shorter. If you're a shorter, you can just go short and cash.
No, I gotta be long something. I don't know, like just fund mandate. Okay, I gotta be long something. Right.
If you want to be long something,
yeah,
snap a little bit of money off your pile and put it to one side and say, this is my high risk stuff. Okay. And we're going to play high risk with this. This other stuff, this is my seed corn. I'm not going to put that in the firing line, but this is my special forces. And you've got to look for special opportunities. So something insane like Silvergate at the moment. Yeah. Something insane. Well, no, it's too insane and it will probably go pear-shaped. So we won't talk about the Bitcoin trust. but grayscale. We won't talk about that. But something like Silvergate, I think Silvergate, the bank, the crypto bank, it's absolutely on its rear end, and all you got to decide is it going to go bust or not? That's it. That's all you got to go. You got to do all the research you like, go to the ends of the world reading up on it, and then at the end of it, go, is it going to go bust or not? And if it isn't in your mind, buy a bit, and you might turn out to be pretty smart. So special opportunities at the moment is the only place I'm playing.
That's interesting. That's like buying foreclosed. Your philosophy is kind of like buying foreclosed homes. You're going to buy some really distressed assets, hopefully renovate them up a little bit, fix them up, and flip them for a higher price later on. I'm going to finish up on actually the housing market because I think that's a good place to end here. U.S. pending home sales is down 37% in October. This is the most on record of any year or any month, more than 2008. I understand that last year there was a huge surge in sales, and perhaps a lot of this decline was because of this balancing out. But still, that doesn't look great. That looks terrible. That looks scary. People are going to lose their homes.
Interest rates. People, and it never used to be like this in America, but they've gone over the event horizon. People buy as much house as they can afford. That's it. They don't care about really, the value of it. They care about buying as big a nicer house as they can possibly afford. And that's a function of interest rates and leverage. So they will lever themselves up to their earlobes to get into a nice house, and they will take that big risk. Well, again, when the market is going your way, you appear to be a flaming genius. When interest rates go up, it's a hard road.
Let me ask you this right now. Suppose you are. Okay, let me give you two scenarios. Suppose you own a home, that's your primary residence, and you don't own any other homes. What do you do right now? Are you holding? Are you moving to are you downsizing? What are you doing?
Your home is not an investment. Never should be, never should be. Your home is your home. If you want to go play dice with your home, you are on the road to perdition.
Okay.
Never gamble with your home.
All right. That's a good point, actually. Some people, like you said, lever too much to buy a nice home, and they really can't afford that. And now interest rates are going up, and they're feeling some more pain. What if you have a second or third home as investments? You have a primary residence, and you have speculative residential real estate as investments. What are you doing now?
Well, I mean, one of my little secret investment tips is always invest alongside the government, i.e. the people that work in the government. So if the people that work in the government buy chickens, invest in chickens, okay? And you can be guaranteed that people in government buy homes and second homes and third homes and fourth homes if they can afford it, right? So you'll be safe there. Maybe not in the short term.
Wait. Let's unpack that. Why people in the government, Clem? Let me unpack that.
Well, because they look after their own interests first, don't they? That's pretty obvious, right?
Don't we all look after our own interests first, Clem?
Exactly, but they've got the power to steer things. And so therefore they look after themselves first. I see. And they wouldn't do anything to blow themselves up.
I see. All right. Well, I'm not advocating against one way or another. I think altruism is a great thing.
It's just human nature.
Yeah,
it's just human nature, David. But
Sam Bankman-Fried was
alongside the government.
Sam Bankman-Fried was an advocate of effective altruism, a philosophy that he tried to preach and didn't really work out for him. He was quite the opposite of altruistic, as it turns out. But anyway, Clem, I appreciate your candor as always. Thank you very much for a very thorough interview. I look forward to speaking with you again soon.
Speak to you soon. Bye-bye now.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe to our YouTube channel.